Here are the top 10 income investments I covered back in November 2024. Since then, I've sold these 2, and these 3 have fallen outside the top 10 to increase weighting to fixed income and utilities. Today, I'll get you up to speed on what's been happening with each of my top 10 holdings. I was made in Australia, so this episode comes with a 10% tariff. Just kidding, of course. There are no tariffs on imported services, and yes, that's still accurate. Okay, let's dive straight in. My largest holding is a credit fund with the ticker FSCO, and as I record this, it's yielding 11.8%. This closed-end fund does some private lending to businesses, invests in loans from other lenders, and holds corporate bonds. The yield is high because the borrowers are not investment grade. When I reviewed FSCO in July 2024, it was trading at a 14% discount to net asset value. Turned out to be a good price. Since then, the discount has shrunk to 9.5%. And if you were quick, it dipped down to almost a 20% discount. FSCO has only been around since November 2022, but it's already raised its dividend 3 times. This fund has had an impressive run. The tariff chaos shrank the 1-year total return for the S&P 500 all the way down to 6%. And meanwhile, FSCO has delivered a return of, 26%. Not bad for a boring old credit fund. By the way, if you're new to the channel, I retired in 2017, and that's when I got serious about researching my investments in greater depth, and this channel is where I share what I learn. I mostly focus on stocks and funds paying consistent yields of 8 to 12%, and if you'd like a copy of my portfolio, it's available via Armchair Insider, link in the description, it's free. Number 2, PBDC is currently yielding just over 10.5%. This is a fund dedicated to business development companies, or BDCs. These are private lenders, and their customers are medium-sized businesses. Putnam's BDC fund currently invests in 24 BDCs. The fund is heavily weighted towards the top 10 holdings, which make up 72% of the portfolio. You can view those 10 by clicking Holdings on Seeking Alpha. If we compare PBDC's price to the S&P 500 since the fund was launched in September 2022, it looks a bit weak. This chart came from Yahoo Finance, and it doesn't show the income from either fund, which, by the way, is where most of PBDC's return comes from, the income. A total return chart includes the changes in price and the income paid to the shareholders, so let's look at that. Much better. The S&P 500, represented here by SPYI, pays a yield of just over 1%, so its total return bumps up from 45% to 50%. Meanwhile, PBDC's total return jumps up to 60%. Speaking of total return, let me give you a quick shortcut. When you're researching a stock or a fund, just click Momentum, then scroll down. It will instantly give you a 1-year total return chart versus the S&P 500. You can change the timeline, or you can add more stocks for comparison and even delete the S&P 500 if you want to. I have some favorite BDCs. I've reviewed 5 of them on this channel, and I'll link to a BDC playlist that includes those 5 reviews. But realistically, no one's going to research all 50 BDCs, so I outsource a big chunk of my BDC investments to PBDC. The management fee is 0.75%, but the total expenses look crazy high because the SEC requires BDC funds to count the business expenses of the companies it holds as fund expenses. The confusing expenses and the effect of interest rates on BDCs are covered in this interview I did with the PBDC fund manager, Mike Petro. Next up is an individual BDC called Ares Capital, yielding 9.5%. You may have noticed that it appeared already as the 3rd largest holding in PBDC's portfolio. So my allocation to this one is actually a little more than my cap of 5%. It's more like 5.5%. Why the love for ARCC? It stands apart from the others in size, as you can see from this Raymond James report. It's the big daddy. That means it has a much more diversified loan portfolio than smaller lenders that it competes with. Secondly, ARCC has a consistent payout history going back almost 20 years. And last of all, it's trading at just over 1 times NAV, which is less expensive than Main Street Capital, another high-quality BDC. If you want to see how expensive a BDC is compared to its assets, you can select charting, then metrics, then valuation, and price to book. I usually delete price return for a simpler, cleaner chart, and then I just click update chart. ARCC's price to book recently returned to its historical range of around 1. And if we zoom out to the 10-year history by clicking here, it's even clearer. While we're looking at the long-term history, this 10-year total return chart shows that both funds have outperformed the S&P 500. Main has delivered a higher total return, but its price is more volatile and it pays a lower dividend than ARCC. Before we get into the fourth holding, I want to thank Seeking Alpha for sponsoring this video. You won't have to fast forward past an ad read because there isn't one. They didn't send me a script. They didn't even send me any bullet points. Their only request was to share how I use the platform, which I do that in most videos anyway. CEFS is yielding just over 9%, and this one is a fund of funds, so it offers a lot of diversification. The fund manager, Saba, actively manages over 100 holdings, and looking through some of them, we can see examples like gold and precious metals, tech and private equity, credit funds like PIMCO's PDX, global infrastructure, muni bonds. There are a lot of different veggies in this income soup. The fund of funds concept does sound pretty good, but the negative is fees. Saba takes a 1.1% fee, and each fund has fees built into it. The reason I own this fund and not other funds of funds is that Saba adds more value than just actively managing the 100+ holdings. Saba is also an active investor, and that means they take fairly aggressive steps to increase the returns for shareholders, including themselves. For example, they pressured BlackRock to offer investors the full asset value of 2 of their funds, even though they were trading at a discount to net asset value. Those funds were BMEZ and Big Z. Looking at total return over the past year, CEFS has managed to stay comfortably ahead of the S&P 500. Most of its returns come from distributions, and those have been consistent at 14 cents a month since 2017. If they have an unusually profitable year, they also pay special distributions. PFFA is currently yielding just over 10%, and it gives me exposure to about 180 preferred stocks. Regular dividends are paid at the company's discretion, but preferred stocks set their payout years in advance. That defined, consistent income stream can be a good fit for many retirees, like this one. As I record this, PFFA has shifted towards fixed preferreds because they expect interest rate cuts at some point. And as of mid-April 2025, they reduced the fund's leverage from the typical 20 to 30% range down to 17% due to market volatility. I always get questions about fees for funds like this because they're so confusing. The total expense ratio of 2.5% looks high because leverage funds like this have to show interest as an expense. The actual management fee is 0.80%. You can buy an ETF that passively tracks a preferred stock index and pay a lower fee than that. PFF only charges 0.46%, but PFFA's active management has outperformed PFF over the past year, so I don't think the 0.34% saving is really that much of a saving. In a bull market, the S&P 500 would outperform preferred shares, but the recent turbulence has actually allowed PFFA to nose slightly ahead. WDI is yielding 13%, and this is another closed-end credit fund. Compared to the other credit fund I mentioned earlier, FSCO, this one is far more diversified, as you can see from this breakdown. I took this table from an analysis written by Double Dividend Stocks on Seeking Alpha. They wrote an excellent overview of WDI, and I'll include a link to that article in the description. If we take a look at WDI's monthly distributions, the chart looks great. A history going back to 2021 isn't a lot to go on, but no cuts and regular increases is a good start. I hold this fund because I want a diversified basket of credit investments. If you invest exclusively in equities, then it's all about the price and maybe a small amount of dividends, whereas credit investments deliver most of their returns in the form of income. That doesn't mean the price stays still, though. Over the past year, sometimes WDI has outperformed the S&P 500 and sometimes it has underperformed. As long as the income keeps rolling in consistently, I'm not overly concerned with the price movement. At 13%, the yield is high because it's mostly non-rated credit and the leverage is quite high at 33%. The portfolio is a mix of fixed and floating rate assets, but leans more towards fixed rate credit, which would increase in value if interest rates fall. The analysis by Double Dividend explains in more detail how interest rates affect WDI. I'll also include a link for a free trial and a discount for Seeking Alpha. I use their premium level of membership. JBBB yields 8% and holds just one type of credit, collateralized loan obligations, or CLOs. These are pools of business loans and should not be confused with CDOs, which are generally riskier. CDOs can hold some home loans, whereas CLOs are strictly business loans. Important to note that the loans are floating rate, so the income will move in the same direction as the Fed funds rate. 8% is at the lower end of the yield range that I'm looking for, but I'll take it because this fund offers low volatility. Looking at a one-year total return chart, you can see how the S&P 500 jumps all over the place and JBBB is relatively steady. Zooming into the past crazy month, and the contrast in volatility is obvious. EICC yields 8% and is a preferred stock. Earlier I mentioned the PFFA fund holding 180 preferred shares. EICC doesn't offer that diversification. It's just one company, but it's a company I like, Eagle Point. The company manages CLO funds, and I hold one of their funds, EIC, which is further down in the portfolio. We won't cover it today. But EICC isn't a CLO fund like EIC is. It's a share of ownership of the Eagle Point company itself. Because it's a preferred share, the income is defined in advance and it's predictable. It's 8% of $25 a year, which is $2 per year. Simple. No diversification is a bit of a negative, but I bought this one for the low volatility. It's even lower than JBBB, as we can see here over the past year, and even more dramatically over the past month. It barely flinched. UTG is currently yielding just over 7%. This closed-end fund is focused on utilities and infrastructure. I have 3 funds in this sector. The other 2 are UTF and ASGI. You can probably guess why exposure to utilities makes sense, while the 2 issues the market is currently focused on are tariffs and a possible recession. I'm not saying that UTG will be completely untouched by tariffs or a recession, but they don't import goods and people still buy electricity, gas, and data during a recession. The other thing I like about UTG is its long and stable distribution history. More than 20 years without a distribution cut, and over that period, the payouts have almost doubled. My 10th largest holding as I record this is CLOZ or CLOZ, and it's yielding about 9%. This is another CLO fund, and it pays a higher yield than JBBB because it comes with more risk. The pools of business loans in CLO funds are organized into rate tranches, and these help you identify the level of risk. AAA-rated tranches pay the lowest yields and come with the least risk. CLOs focused on the equity tranches are the highest yield and highest risk. As the name implies, the JBBB fund is focused on the BBB tranche. CLOZ pays more than that one because it's a mix of BBB and the lower-rated BB. They also hold some cash, and since I reviewed CLOZ last time, the fund managers have actually slightly increased the cash allocation. So what happened to SVOL and covered call ETFs? SVOL does well during periods of low volatility. I sold it off in stages in early 2025, that's earlier this year, when it became clear that market volatility was coming, and I don't see that changing anytime soon. What about covered call index funds like JEPQ and SPYI? I haven't sold them completely, but I reduced my exposure to several of them by 50% at the end of March. Covered call index funds work well in most market conditions, and the regular ups and downs of the market are not an issue. However, if we have a severe and prolonged bear market, it will reduce the value of the indexes and eventually the distributions. I explained it in this recent episode. So I adjusted some of the weighting from covered call funds to fixed income and utilities, but that's based on my investments and my outlook. I don't know if the market will bounce back next week or next month or in 3 years, but that's the allocation I'm comfortable with during the current uncertainty. These are my 10 largest holdings, but they top out at a maximum allocation of about 3.5%. I don't consider holding these 10 alone to offer enough diversification, so I have another 25 that make up the rest of the portfolio. I shared these 10 today as examples of how you can generate income in a variety of different ways beyond just buying dividend stocks and bonds. The S&P 500 appeared frequently as a reference in the charts today because we're all so familiar with it. But it's not a benchmark I use for my portfolio. The S&P 500 will outperform my portfolio during bull markets and over the long term. However, it doesn't provide much income, and as a retiree, consistent income is what I'm optimizing for. I don't know when you'll watch this video, so my portfolio may have changed since this was recorded. If you'd like to see the current portfolio, it's called Armchair Insider, and it's linked in the description. I update it about once a month, and it's free. The total return charts and distribution charts I use today are handy for comparing income investments, and they're not on Yahoo Finance. You can learn more about how I use these tools in this video, 4 tools for income investing. That wraps it up for this top 10 update. More Armchair Income coming soon.
Armchair Income, that's my hustle and my groove.